All right, let's get into it. If you follow the markets, you've almost certainly heard the name Jeremy Grantham. He's a legendary investor, co-founder of the firm GMO, and maybe the world's most famous bubble hunter. But his story, it's about more than just being right. It's about the incredible difficulty of being right at the wrong time.
And boom, with that one sentence, Grantham lays out the stakes. He doesn't see markets as this smooth, easy ride up. Nope. He sees them as a series of giant cycles, of total euphoria and then complete despair. For him, the pop isn't just a possibility, it's an absolute inevitability. The only question is, when? And you really have to give the man credit. His track record is pretty impressive. He called the Japanese asset bubble way back in the late 80s, he nailed the dot-com mania of the late 90s, and he saw the US housing bubble that led to the 2008 financial crisis. Come on, this isn't just luck. There's a method to the madness. So how does he do it? Well, it all comes down to a single powerful idea that has guided his entire firm, GMO, since 1977. And that idea is reversion to the mean. Think of it like a rubber band. You can stretch it really far in one direction. That's your market bubble, right? Soaring prices, wild optimism, everyone's a genius. But eventually, the laws of physics, or in this case, financial gravity, they have to take over. That rubber band has to snap back to where it started, back to its average. So his strategy sounds deceptively simple. When assets are historically expensive, sell them. When they're historically cheap, you buy them. It's a deeply contrarian approach, which means he is constantly betting against the market's mood. And well, that's where the trouble starts. And this brings us right to the central paradox of Jeremy Grantham's career, what I like to call the curse of being early. Because in the world of investing, being early can feel exactly the same as being wrong. I mean, just take the dot-com bubble. Grantham started warning everyone about it in 1998. And he was right, of course, but the market just kept rocketing up for another 2 years. His firm underperformed, his clients were furious, and he looked like a total fool, right up until the moment the market crashed and he looked like an absolute genius. And this chart right here brilliantly illustrates the real-world cost of his strategy. Just look at their assets under management. It peaks right before a crash, when his warnings are the loudest, and then it just bleeds assets during the roaring bull markets that follow. Why? Because it is incredibly painful to sit on the sidelines while your neighbors are all getting rich. This is the ultimate test of investing, client retention. Can you convince people to stick with a winning strategy even when it's losing month after month? You know, this quote from a Reddit user just perfectly captures the main criticism against him. It's funny because there's a real kernel of truth to it. His timing can be off, sometimes by years, leading a lot of people to just dismiss him as a perma-bear who's always screaming that the sky is falling. So that brings us to today. What is this legendary bubble spotter saying now? Well, he believes the market peak we saw in late 2021 wasn't just a bubble. No, he calls it a superbubble. A superbubble is a rare and dangerous beast. According to Grantham, we've only seen a few in the last century, 1929, 2000, and now 2021. These are those rare moments of true madness, where the belief in a new era pushes valuations to levels that just defy all historical logic, and they always end in a devastating crash. But, this time is different, right? Grantham actually notes that this bubble started to pop in a pretty normal way back in 2022. But then, something totally unprecedented happened. The explosion of AI enthusiasm created a new bubble, mostly in just a handful of tech stocks, inside the deflating superbubble. It's a really strange, historically unique situation. Grantham argues that every great technological revolution, from railroads to the internet, creates a massive stock market bubble. Just look at Amazon. During the dot-com craze, its stock soared 21 times over, and then crashed an almost unbelievable 92%. But from those ashes, it rose to become one of the most dominant companies in the world. The lesson here? The technology can be world-changing, but that initial hype bubble, it still has to pop. But lately, Grantham's focus has expanded. He's looking beyond these market cycles to a series of huge, under-recognized, long-term problems that he believes will fundamentally change the entire investing landscape. He sees a world that's being totally reshaped by 4 major forces: climate damage, serious resource limitations, rising toxicity from plastics and chemicals, and a demographic decline in populations all across the developed world. These aren't just cyclical problems. These are permanent headwinds for the economy. But where there's crisis, there's always opportunity. This chart, from one of his own papers, uses data from 2016, but it really shows just how early we are in the clean energy transition. He believes the decades-long project of decarbonizing the entire global economy represents one of the biggest, most durable investment themes of our lifetime.
So what Grantham is really arguing here is that the post-World War II era of smooth, consistent growth is over. He thinks the coming decades are going to be defined by shocks, by scarcity, and by disruption. The old playbooks just aren't going to work anymore.
And this brings us to his final and maybe his most important point. In this new era, the companies that thrive won't be the ones with the flashiest growth stories. They'll be the ones with bulletproof balance sheets and sustainable business models. It's a call to avoid debt, seek out quality, and seriously question optimistic valuations. So the question he really leaves us with is this: have we entered a new age where the most valuable asset of all is simply the ability to endure?